Good evening, everyone. Respected seniors, fellow professionals, I see also a lot of students. After a prolonged legislative process lasting over 4 years, the Companies Act 2013 is now a reality. It is ushering a new era with 470 sections, 7 schedules, 29 chapters, and plus nearly 350 rules which are likely to be notified. We are living in dynamic times with nearly all significant tax and commercial laws and regulations undergoing major overhaul. As Alvin Toffler says, the illiterate of the 21st century will not be those who cannot read and write, but those who cannot learn, unlearn, and relearn. The far-reaching changes being brought about by Companies Act 2013 include extensive responsibilities cast on auditors, a new definition for fraud, rotation of auditors, independent directors and their rotation, corporate social responsibility, enactment of NFRA, National Financial Reporting Authority, new subsidiary threshold, only 2 layers of investment subsidiaries, restriction on intercorporate loans and investment, further safeguard on related party transactions, mergers of Indian companies with foreign companies. I can go on and on. I'm sure we can ignore these changes only at our peril. So I'm sure the students here will be too happy if the institute were to announce re-exam for all our members and with a 50% of minimum passing marks. Friends, our learned faculty today has prepared a presentation with almost 115 slides to be covered in next 75 minutes. So I don't wish to stand between him and you. And I'll give a brief introduction. Mr. P.R. Ramesh, a fellow chartered accountant, is well known for his ever-readiness to contribute to the profession and academics. This is evident from his involvement in various professional and academic development initiatives, some of which are: he is a member of SEBI Committee on Disclosure and Accounting Standard. He was a member of the Committee for Reforming Regulatory Environment for Doing Business in India, set up by Government of India recently. He was invitee to the committee set up by RBI to assist in convergence of IFRS by banks. He's member of the Technical Committee to review the form and presentation of balance sheet of Reserve Bank of India itself. He is member of IRDA Standing Committee on Accounting Issues. He was special invitee to NACAS. He's been co-opted in various professional bodies, including Accounting Standard Boards of India, of ICAI. He was past member of the Vision and Restructuring Committee set up by ICAI. He's been past member of the Auditing Practices Committee of ICAI, past member of the Secretarial Standards Boards constituted by the ICSI. He's been member of various industry bodies such as CII, FICCI, and so on. Well, and he's lectured extensively in India and abroad. So, friends, amidst all these activities, Ramesh also finds time to lead a very successful practice. He's associated with Deloitte, most of us know. So I now request my colleague Raman Jokhakar to felicitate Ramesh with a token of our appreciation and respect. Over to you, Ramesh.
Nitin, thank you for those kind words and introduction. Distinguished persons present at the dais, very, very distinguished persons here, Mr. N.P. Sarda, my senior mentor, and I must confess that I feel completely inadequate because I'm carrying so many papers, and he can speak for twice or 10 times the length of time as I would without a shred of paper. And you know, we are all in relation to what he does, perhaps illiterate. Alvin Toffler perhaps should amend that definition to say that the literate of the 21st century are those who can speak without a shred of paper. Mr. Sada, your ability to do so and your knowledge is. So pardon me if I, in the course of my talk, refer to a book or try and recall a section or misquote a section. I am also part of the illiterates insofar as this act is concerned. I've said this in some fora earlier, saying in perhaps Mr. Sarda's lifetime, he may have seen 2 Companies Acts. In my lifetime, I have seen only one, which is this Companies Act 2013. And I'm not sure, and I'm sure rather, I will not see another. For many young people here, they may see 2 acts. This is a, shall I say, a landmark event. We've been waiting and waiting and waiting. I have appeared before various committees of select committees of the Parliament. From the time Pranab Mukherjee was heading one of those committees to the most recent Yashwant Sinha committee, always in the hope that this will never happen. So you could say so many things, you could hear so many things. I still vividly recall once appearing in that hall of Parliament where there was a proposal in the then Companies Bill that you required central government approval to shifting the registered office even within the same city. Supposing your tenancy expired, you wanted to move your registered office, you needed central government's approval. So I was passionately arguing against the difficulty of getting such an approval in those days when getting approval was not electronic and you needed to fly to Delhi and several trips perhaps you would then get. To which one member of parliament turned around and said, but what about vanishing companies? So I said, vanishing company will not take central government's approval to vanish. So if you really want to vanish, so why do you put in this sort of provision? But we have come a long way. And the reality is that when you really look at any new legislation, we can talk about the negative aspects of it, we can criticize the legislation, but we really need to go back and look at why do you need a new legislation? What do you expect that new legislation to address? And in that context, let's also look at the Companies Act. I know I have a lot of slides, but I only intend to go through some of the critical provisions. People have called this not the Companies Act, but an act of audit for the auditors and the accounting profession. In reality, if you see, perhaps a large part of it is so. And when I come to that section on accounts and audit, I think being part of the profession, and a lot of you are part of the same profession, never before in the history of our profession has a legislation such a significant or profound impact. We haven't seen the last of it because the rules are yet to be finalized, but I think it's time we need to really look at this legislation a little more closely. Now, any legislation requires a change, or you will have a new piece of legislation, provided the earlier one is too complex and there is need for simplification. As often it is touted, one needs to simplify, or there are too many ambiguities. It's not complex, but it's ambiguous, and therefore you need to provide clarity, or to make it more nimble, because this is a legislation which should facilitate corporates to function better. As you know, in India, ease of doing business, we are ranked 132 out of 185 countries in the world. And in certain components of it, like enforcing contracts, we are ranked 184 out of 185. That means we are second worst in the world in enforcing contracts. In that context, look at a legislation. And when you look at a legislation, how do you enforce that legislation? Through the same system which is clogged. And this is a World Bank report which comes out every year. Our ranking has not improved. We are the second worst country in the world in enforcing a contract. Why? Because our judicial system is clogged, which is a reality. So there are 700,000 cases pending in Supreme Court. There are 4 million cases pending in high courts, 27 or 30 million cases pending in lower courts, forget tribunals and various other bodies. Now, in this legislation, whenever you look at a power to punish or this or that, all of it gets enforced, even if it is done unfairly, through that same redressal mechanism which you need to go through. Even you may have an NCLT, a National Company Law Tribunal. Hopefully that should not get clogged. Again, we talk of the number of levels, what it is. But put that in that context and trying to say, do we need something which is more harsher? Look at it in the hands of the persons who will enforce it. And the concern which generally I have, and this is a very progressive legislation, no doubt about it. A lot of effort has gone into it. At least I have seen it in the rules, a lot of effort, hands-on. I have seen people working very hard. But in India, the problem is not the quality of the law, but the quality of administration of the law. And it is that context you please focus on some of the provisions which I point out and look at it in the context of it being applied by somebody who perhaps may not be the right person to apply or may not apply it in the right manner. And that is where the concern arises. It should therefore provide flexibility and scalability. Now, flexibility, it has been provided for the law makers, in that more than 300 sections, as you know, have rules as may be prescribed and various forms prescribed as may be prescribed, whole host of things which are there. Equally, when you come up with a new law, you also look at, does this have provisions which address the current developments in the social, business, technological, legal or political environments? And I think this law does to a great extent, because it at least recognizes the developments in technology. Is it transparent? Is there accountability? Well, to some extent there is. But I think when you go through some of the nitty-gritties, there are challenges. Now, where are we today? If you see, you've had the minister speaking at various forums. I have heard the minister speak, I've heard the others speak. And we've had, through various bodies, representative the ministry even before this law was passed. Even before it was passed by the Lok Sabha, even before it was passed, after being passed by the Lok Sabha, before it was passed by the Rajya Sabha. The single statement which was always made is, we will look at it, we will provide relief in some manner through rules. Now where are we? We have two sets of rules which have come out. We have 98 sections which have been notified. There are a lot of those sections which have been notified. Those rules are in draft form. But for the first time, I would say generally for the first time, maybe there have been many more occasions, that an opportunity is given to the public at large to give their inputs on the rules. And the rules have been framed by a lot of professionals who have been involved. They put in a lot of effort over months. And now, hopefully, through that website in the MCA, as you know, you, I, anybody can go there, put in our comments. Any number of times we can put in our comments against a specific rule. And the ministry has assured that they will look at all those comments, factor in all, both in terms of number and in terms of quality of the comments, who is making the comment. When I mean quality, as to who's making the comment. And I'm hoping that when organizations like BCAS or industry bodies make a comment, it is not viewed as a comment from one person, but a comment from a collective body. The last date for uploading the comments on the rules for the first set of rules was 8th of October, which has been extended by 2 days. So we have still time till the 10th of October to go back and put in our comments. Each one of you are free to write. This is a great opportunity, digital, so you can put in all those comments. And I think this is something which should be welcome. And the people today in the ministry, my own view, are very receptive, hardworking, no doubt about it. But as I said, at the end of the day, we need to really look at this being applied by the next generations to follow. Now, when I come back to this issue, as I said, whilst we will still talk about some of the sections and the difficulties in some of the sections, I'm not just going to speak about the good parts of it, and I think I'll focus on some of the larger aspects, leave enough time for us to discuss, and I think that's what I should do. If I take away all that time, there'll be very little time for you all to raise your views, and I'm going to do that. So I may rush through some portions, and I'll be conscious of that time to give a lot more time for you to come up with your thoughts. All I'm trying to say here is, what is cast in stone is the law. What is variable is the rule, are the rules. And my own view, the rules cannot be inconsistent with the law. However, one can look at maybe 3 different sections of the law. There is a section 462 where you can apply the law to certain class of companies differently. There is a section 467 which permits amendments to schedules. And there is the last section 470 which enables which gives the power to remove difficulties. But that power to remove difficulties can only be in terms of clearing out ambiguities. It cannot, by its very nature, contradict what is the law. Maybe the only way is not to notify a particular section or make operative a particular section till such time that section is amended, and I don't know which government will amend and when that amendment will happen. I don't even know whether the parliament will meet again, and if so, in what circumstances it will meet again. So this is where we are. And I'll point out to you, and I'm sure you'll have many more thoughts on that, as to what are those sections which are troublesome, which will cause significant operational difficulties, and particularly those sections relating to accounting and audit. And there may be many views in that, but still we shall look at it. So I won't get into the background as much as to say it's a welcome law. There is a lot of emphasis on e-regulation. Technology for the first time has been recognized, so let's not spend time on to that. As you know, 98 sections have been notified, which does not require any rules to be prescribed. In addition, what has been notified, actually if you see section 133, which deals with financial statements or accounting standards, actually deals with accounting standards, has been notified. Now, NFRA, National Financial Reporting Authority, has not been formed, and therefore the ministry has issued out this circular saying till such time NFRA has been formed and its standards are prescribed, the existing notified standards shall continue. So at least the way one looks at it is the existing notified accounting standards will continue. Now there may be a lot of places where I may be expressing a view which is not the final view, and that may be one of the views. There is a lot of ambiguity which is still there in the law, and I think that is important. Then the next question which comes up, again there could be two views. There are lots of places in the law which says from the commencement of the act. I think a more appropriate reading of that will be a commencement of that particular section of the act as opposed to commencement of the act in general. So it is not the date in September which makes it the date of commencement of the act. If you say 1 year from the commencement of the act, and let's say the section itself is made operative after 1 year, how will you give effect to something? That means the time is up. It's illogical. So one has to put it in that context and look at it in the context of 1 year. So the 98 which have been there is a list of those 98, which includes the section relating to definitions. And to me, there are issues in some of the definitions, because those definitions again form the core. Wherever there is a reference to that, there is an issue with so far as definition. And I will touch upon some of those. I won't spend time on incorporation of companies. As you would see, the whole issue of the number of, you had earlier an association of persons. Now that limit has been significantly raised. Earlier you had the issue of number of persons not exceeding 20. This is what I would say, keeping up with times. Today you can have larger entities in a way it is. So in incorporation, what is new really is today you have a one-person company. Now this is very interesting that you have if you look at the type of companies, you have a public company, you have a private company, you have a one-person company. One-person company has a lot of exemptions from its operations, which makes it very, very flexible. Of course, its size is such between 50 lakhs and 2 crores in terms of capital. And if it crosses the barriers, you have to convert it into a private company or a public company, as the case may be. And one-person company needs to have at least one director. Obviously, it's one-person company. You need to have at least one director. One will have to wait and see how this pans out, but this is a very interesting development under the Companies Act. You will see it should have a minimum of one director. You can't have less than one director. You can't have half a director, but the law says you shall have a minimum of one director. There are relaxations on no AGM need to be held, provisions on holding board meetings are there. I think it will help some proprietary concerns to convert themselves into one-person company. But mind you, you're moving into a regulated environment as opposed to an unregulated environment. That's another risk. Everything has a price. There are no free lunches for becoming a company. Then you have a small company, as you would see, which has a capital of 50 lakhs. and well, it can't exceed 5 crores, or the turnover which is ranging from say 2 crores to 20 crores. I'm sorry, the figures are in millions. Ideally, the figures should have been in crores for all of it. There are relaxation to a small company, cash flow statement not required, annual return can be signed by one person, but these are not so much an issue. Similarly, you have a provision for dormant companies. I'm rushing through these slides because they're not so critical as much as what it is. It says if you have no financial transactions other than in paying fees and incurring expenses, it can be declared as a dormant company, and if you make an application to the ROC. Now let's come to some of the difficult provisions, some of them. The first one, which is the core, as you would see in terms of types of capital, I know you've heard this time and time again, but this becomes the very core, is when you're really looking at it, and if you look at the definition of share capital, and the definition of share capital, particularly when you come to the context of consolidation and subsidiary, it includes preference capital. So the types of capital are equity capital with voting rights, with differential voting rights, nothing new there. Preference shares, now for the first time you can issue preference shares, but it has a time limit of 20 years, except if it is in relation to infrastructure, where you can have for more than 20 years. And there are new rules, or rather this section for the first time provides in timelines in terms of by which time you should allot, and after allotment by which time you should refund and interest. So those are good provisions which are there in the Companies Act, which are very, very welcome provisions, which have punishments of imprisonment also. But just park this, I'll come to this definition that the share capital includes preference capital. And when it includes preference capital, when you come to the definition of subsidiary, you have a huge issue there, and that is an issue. Now, whilst on the subject of capital, and when you, which is not there in the slide, I'll come to that, is this issue of bonus shares. Now, bonus shares, let's take the very first bullet which is here. Bonus shares can be made out of free reserves or securities premium account or capital redemption. Seemingly there is no problem. However, the problem is with the definition of free reserves. And if I may read out to you the definition of free reserve, and I think that is where, let's assume you don't have securities premium account which is adequate, and you don't have a capital redemption account. Free reserve says, and mind you can interpret it differently, and I would, I'll shudder to see when an ROC comes in for an inspection and then interprets it, we do have a problem. It says free reserves under section 2 subsection 43 says free reserves means such reserves which as per the latest audited balance sheet are available for distribution of dividend, no problem till here, provided that 1. Any amount representing unrealized gains, notional gains, or revaluation of assets, whether shown as reserves or otherwise. So any amount representing unrealized gains, and then the second one, any change in the carrying amount of an asset or of a liability recognized in equity, including surplus in profit loss account, on measurement of the asset or liability at fair value shall not be treated as free reserves. What is unrealized gains? Becomes a question. That means free reserves firstly should exclude unrealized gains. To me, if one were to take an extreme interpretation of the arithmetic, everything which you have sold on credit is unrealized. Should you deduct receivables from that? Then, you get on to you sell goods on credit, and it's not the whole receivable, only the gain perhaps is unrealized. Which part of that receivable complete? How will you do this arithmetic? And talking of fair value, now in accounting, I can understand where an item is marked to market and always accounted at fair value. The intention is to eliminate, and they use the word notional gains. Take foreign exchange. Marked to market of forex, rupees depreciated. We have para 46, para 46A of AS 11, which is there. Is that notional gain if rupee has appreciated, or for software companies, when rupee depreciates, there is a gain? all export-oriented companies. Is that a notional gain when it is not yet realized? And particularly, it is genuinely not realized because you could have, even on a liability, a notional gain. When you mark a loan to an exchange rate, you could have, in theory, a notional gain. So how will free reserves be computed? There is need for clarity in this. This forms the very basis for issue of bonus shares. This will form the very basis for declaration of dividend out of profits when you go to the rules for declaration of dividend out of profits. And I think one needs far more. The intent, of course, as you know, when this whole issue of IFRS and accounting standards were being discussed, there was a feeling within the government that IFRS will lead to distribution of unrealized profits, particularly mark-to-market fair value gains. So they said we must find a mechanism to ensure that dividend is not distributed out of mark-to-market gains, because after all, mark-to-market or notional gains are not realized gains, therefore it must be removed. But in trying to do that, we need to create a mechanism as to how do you compute it, and what are we trying to do that. If it's something which is directly taken to reserve, like you have in cash flow hedging, where you accumulate gains and losses to a cash flow hedging reserve, it's a different matter altogether, which is subsequently recycled into the profit and loss account when the underlying transaction happens. But this is not so. This is a very, very generic statement of free reserves. So in that context, when you issue bonus shares, please look at as to how you are able to do that bonus shares. And what is new now, if you really see, it says bonus shares cannot be issued in lieu of dividend. I don't know what it really means as to how will you interpret that bonus shares are not in lieu of dividend. Let's say I have not declared dividends to our shareholders, there is profits. And suddenly there's clamor at every AGM, issue bonus shares, and immediately thereafter issued. So is it in lieu of, or is it if there is dividend, you can always say it's in addition to dividend. But does it mean, therefore, that before you issue bonus shares, you should have declared dividend, and in which year? Is the immediately preceding year? I think there are issues as far as this is concerned. The other things are not necessarily useful to say if you've defaulted on statutory dues. But the question is when? How long back? What is it? These are clarifications. I think there is much more which needs to come insofar as this is concerned. It cannot be that there is a general bar on declaration of bonus shares as a result of it. So back to this issue on definitions, you have this issue of free reserve. Allotment of securities, no issue here, as I said, except that there are timelines, must be completed within 60 days, and I would see application money should be refunded within 15 days from the 60 days. That means from the within the 75 days. Otherwise, the rate of interest is 12%, a very, very steep rate of interest, but rightly so. We could argue as far as that is concerned. Now, utilization of securities premium. This is Section 52 of the Companies Act. You look at Section 52 of the Companies Act, which is equivalent to Section 78 of the erstwhile Act. As you know, Section 78 of the erstwhile Act permitted utilization of securities premium for 4 different purposes, and one of them included premium on redemption of debentures, right, or even shares. You could use the securities premium account. Now, as you know, when all this discussion was happening around IFRS and India standards, that premium, because preference capital is treated as a debt and debt is debt in any case, premium on redemption has to go through P&L account under the IFRS equivalent standards, which is India's. So therefore, it was visualized, if we have to have the Companies Act aligned to India's, because we had this conflict, as you know, the earlier accounting standards too did not specify how you should use securities premium account, because that's a matter of law. The accounting, theoretically, if you conceptually talk of accounting, premium has to hit P&L. There's nothing in the law which says premium shall be taken out of the premium on redemption shall be taken out of securities premium. It's only because law overrides standards in terms of our accounting framework. Therefore, Section 78 had an overriding effect on the accounting standards, and therefore Section 78 permitted it, and therefore it was allowed. It's an optional treatment. But now the equivalent section 52 has two components. One component where it permits, and the other component which says for such class of companies as may be prescribed, which comply with accounting standards. I don't know why they say that, because every company shall comply with accounting standard. There is no choice under section 133. It says for such class of companies as may be prescribed and comply with accounting standards. It almost gives you the impression that if you have a qualified statement, a qualified audit report, you cannot utilize securities premium account in the manner in which it is specified. I mean, I may be extreme in this in some times, but that arises from the fact, as I said, depending on who applies that law, and we have to be conscious of that fact. So when you applied, why are there two parts? The two parts are when you have Ind AS standards, and Ind AS standards, it is expected, will not apply to all companies. Currently, I am digressing here. I'll come back to this subject as well as accounting when I'll talk about it while accounting. Currently, there is a lot of discussion happening around in the government and in the Institute of Chartered Accountants as to whether there should be one set of standards or whether there should be two sets of standards. The general feeling across the government is there should be one set of standards. From that one set of standards, you remove certain exemptions for carve-outs for certain companies, maybe SMEs. Today, in some of the standards, like for instance in the accounting standard 15, which relates to employee benefits, there is a special treatment for companies employing less than 50 persons. You don't need to do an actuarial valuation, etc. So within a standard, depending on the size of the entity, or we also have tier 1, 2, 3 types of companies in the applicability of certain set of standards. So the general thinking of the government seems to be have one set of standards and do carve-outs. But today in the landscape, though not notified, we have a whole set of Ind AS with a different numbering. We have the existing standards with a different numbering. How will you bring both of these together into one, do all those carve-outs? When will it be done? Who will understand the complexity? If you read Ind AS, it's in Queen's English. We great difficulty got used to the existing English in the standards. Now you will have all of that and transpose financial instrument standard onto it, transpose agriculture accounting, first time adoption, share-based payments, you name the types of standards into that whole landscape, fair value measurement standard, IFRICs you put into that, and then start carving out, I think it perhaps would be a nightmare. But the point I'm trying to go home, this section has two parts. One, you can utilize the premium for certain set of companies. You are not allowed to utilize the premium for other sets of companies which will be notified. And that gets linked to the notification of the Ind AS or equivalent standards, and we will have to wait and see how it is. That similar confusion, when I come to the subject of depreciation, you'll find we have the same issue insofar as depreciation is concerned. And the whole idea was that when all this preparation of the Companies Act was happening over the last few years, simultaneously with the preparation of Ind AS, so one was trying to avoid a conflict between law and the standards and ensure the supremacy of accounting standards so that we don't have to deal with a legal opinion to say law overrides standard or whether schedule to a law overrides the section. All those one wanted to bury. But in the process, what happened? Ind AS got deferred, Companies Act got notified in the way it is. Now we have to wait and see as to how this is. There is serious operational difficulty as far as this is concerned. Debentures, there is no issue here insofar as debentures is concerned. Now let's come to the subject of holding and subsidiary company. I think this is a very, very important subject. There are three issues here. The first issue is on the definition of subsidiary as to what is a subsidiary. It talks of, and if you see the wording also which is in a way put in here, first is the holding company is one which controls the composition of the board. So we need to get into the definition of control. So the definition of control becomes extremely important in the context. What do you mean control the composition? The second, it says exercises or controls more than 50% of the total share capital. Now, in the 1956 Act, and consistent with the standards, if you controlled, or rather you controlled more than one half of the voting power, it was linked to voting. It was linked to voting, it was linked to control of composition of the board, and when it was linked to voting, preference shares don't have that voting power. So if you had controlled more than one half of the equity capital, it was a subsidiary. So you will have a strange situation here, where let's hypothetically take, under the 1956 Act, you have company A, which had 100% of the preference capital, and let's say the preference capital was 1 crore. It held 100% of that preference capital. Then they brought in another investor who's only short-term investor, and that investor invested, let us say 10 crores of rupees by way of preference capital, and held 100% of that preference capital, which is, let's say, company C invested in company B 100% of the preferences. So companies B hold total capital was 11 crores, 1 crore equity, 10 crores preference capital, 1 crore equity held by company A, and company C holds 10 crores of preference capital. Under the old Companies Act, company B was a subsidiary of company A, wholly owned subsidiary of company A, because the entire equity is held by company A. Under the new Companies Act, on this definition, who exercises more than 50% of the total capital? Company C, because it has 10 crores of preference capital, 10 out of 11 crores. No longer is A the parent company, but C the parent company. Is this intended? The government official in seminars has gone vocal and emphatic, saying this is intended. This is what we wanted. It's not a drafting error. He said, let us not mistake ourselves. It is not a drafting error. I've had in private some legal persons come and tell me that it is you accountants who have caused this problem. You structuring in a manner that there is 10 crores of preference, 1 crore of equity, and you have also done it. They give examples, say insurance company, cap is 26%. You've got around that cap by actually preference capital funding and other ways. So effectively you guys are structuring, and in reality it is controlled by somebody else. Now one could get into all of it, but what is the operational issue it causes? Subsidiary, holding company, associate, joint venture, definitions and determination or identification has to be consistent across laws. I should know who's my parent. I can't say he is my parent for the purpose of Companies Act administration, and he is my parent for the purpose of accounting. Because the accounting standards definition of subsidiary is completely different from the accounting standards definition, the definition of subsidiary under the Companies Act. This is a serious issue. And mind you, the section relating to definitions has already been notified. Now comes the question, and as I said, the circular says, section 133 relating to accounting standards says, that circular says, the old accounting standards apply. So under the old accounting standards, 50% of the voting power is this holding company subsidiary. How do you consolidate? Which ones do you consolidate? Why do we need this? We don't need this challenge, and half-year results are come up. Who's going to provide that clarity? Because half-yearly, and there are a number of companies which are already publishing quarterly consolidated results, listed companies, because SEBI said, you decide at the beginning of the year whether you will publish consolidated or not. And once you start publishing consolidated, you shall do it every quarter. Now I can't say New Companies Act, I won't do. That's not a choice. SEBI is a different regulator. The question is, how do I apply accounting? Can I take the view that forget Companies Act, that is more for determining a subsidiary for the purpose of administering the law? Because when it relates to the definition of subsidiary, it goes on to many sections, whether it is loans to a subsidiary, consolidated financial statements, related party transactions. It has ramifications. And I think this, as I said, intention may be one thing, putting its intention into practice and is causing significant operational difficulty in the way it is. And this would have been a classic case where you defer the section, but there's no way you can defer the section or definition section, because if you defer the definition section, the entire edifice collapses. I really feel this is a challenge insofar as accounting. I'm only hoping, and if I come to the subject of accounting, in the rules to the section relating to requirement to prepare consolidated financial statements, it says consolidated financial statements shall be prepared in accordance with accounting standards. So I'm hoping that if there is a specific section which tells you how to consolidate and it refers to accounting standards, it means, I presume, the definition of subsidiary therein shall be the definition in accordance with accounting standards. Because if you try to put accounting standards definition in the Companies Act, we will have huge problems, because accounting standards definition itself is changing insofar as what is subsidiary. If you see IFRS 10, it's moved many steps away. It's moved away from being controlling to being in a position to control. You could be a subsidiary even if you had 20% shares. If the remaining 80% are so widely dispersed by shareholders who never attend meetings, do not vote, and have no ability, you are controlling. So there are different tests which are coming up in IFRS, which is complete, and which will one day come into Ind AS. So all I'm trying to say is leave accounting definitions to accountants and accounting financial reporting to accountants. Don't leave it to lawmakers to tell how financial statements should be. And that's the challenge in this. I think I need to move on to accounting. I've skipped deposits, so I won't again. Now, let me give you the accounting picture. And then I'll come to the auditing picture. Auditing picture is even more serious. Accounting picture is not serious, but perhaps more different. Okay. The government will issue standards, or the National Financial Reporting Authority will issue accounting standards. As I said, there is currently discussion on whether there should be one set of standards or two sets of standards. If you look at the general picture, there are 12 lakh companies. And if you really see, there are companies which are paid up capital of greater than, I think 2 crores, 5 crores will be around 24,000. 5 crores is more than 20, is around 24,000. If you bring that down to 2 crores, it will be even, 2 crores is 25,000. If you raise the capital to 5 crores, it's even smaller number. So number of large companies are a few thousands. So the question is, would you require this whole new set of standards to be applied to everybody in, when, what? There will be whole issues. We don't have a set of standards for SMEs in the way it should be, but that's a big, big debate. Currently, I don't think there is any choice but to have two sets of standards. And there is a lot of pressure from the government to have Ind AS rolled out, modified and rolled out. So there has been a lot of talk as to whether it should be 1st April 2015, with the previous year 13-14 being also on Ind AS. When you do 1st of April 2015, the previous year's figure will be, 1st of April 2015 is what is the vision, and the previous year 15 will be on Ind AS. So there is a lot of talk, various dates. Insurance Regulatory and Development Authority believes that it can't apply before 2018, not earlier than, because the insurance contracts IFRS 4, which is internationally itself, the existing standard is a wishy-washy standard. The new standard is a complex one, will be operational only from 2018. So our insurance sector perhaps will apply it much later. So insurance companies will be subsidiaries, then the issue of Reserve Bank when it will decide. But what is good is that at least there is clarity in terms of existing standards continuing right now till NFRA happens. NFRA has to be formed. It should form the body within it to set standards, start working on standards, start notifying. So that's a long drawn process. I would still see that our existing standards may continue to happen. But one thing which has happened is, which was done through a SEBI notification earlier, is now when you are doing mergers and amalgamations or restructuring, the scheme shall comply with accounting standards. It's mandated. Therefore, we need to have accounting standards very clearly as to what are those accounting standards. Because otherwise, how will you have a scheme of a merger or a demerger, as the case may be, which complies with accounting standards? Now, whilst on the subject of accounting standards, what less emphasis has been paid generally, everybody talks of accounting, is the issue of depreciation. If you look at Schedule 3, which is there to the Companies Act, it lays down, it is different from the existing Schedule 14. What is different? It moves away from rates to useful lives. And it has two parts to it. It says, consistent with Ind AS or IFRS, for those sets of companies to whom Ind AS or IFRS standards apply, you shall depreciate based on useful lives. Then the question comes up, what if and there are indicative useful lives. So what it then says is, all these useful lives are indicative useful lives. You can depreciate based on useful life. However, if your useful life is different from the useful lives shown here, please disclose those useful lives. Which is right. That's because when Ind AS was discussed, there was a question. Ind AS said depreciation shall be on useful life. That is the original cost or the revalued amount, as the case may be, less the residual value shall be depreciated over the useful life. Then the question arose, if everybody did what they wanted, government was worried, how will you enforce? So the government said, no, we must prescribe useful life. We can't have a situation where there is no depreciation schedule under the Companies Act. So we had this Schedule 3. A very inclusive process was then followed by NACAS. Pardon? Sorry, Schedule 2. I'm so sorry. I'm still on to that. Schedule 3 is a different one. I know. My apologies. See, this is what happens when you are old. Sada, unlike you. Your memory is phenomenal. So all I'm trying to say here is, at that point in time, there was this, it was an inclusive process. All industries were invited to give their views on what is useful life. So many sectors came up. Steel came and gave their useful life. Power sector came up and gave their useful lives. All that has been factored into this schedule, if you would see. Now, in this schedule, it has two parts. One set of companies where you cannot depreciate, have a useful life greater than what is indicated. That means you can't depreciate over a longer period, which is consistent with our earlier Schedule 14, which says this depreciation shall be the minimum depreciation. And for the other set of companies, you can have a longer useful life, you can have a shorter useful life, you can what you want so long as you disclose. So you will have a strange situation, assuming Ind AS is notified, that a company which is not under Ind AS has to provide that depreciation, cannot provide lower than it, whereas another company which is on Ind AS can provide a lower depreciation for the same asset and perhaps is in the same industry, maybe operating in the same industry. But if you see, there are a whole host of changes in rates, and mind you, then the next question comes up, is this schedule operational? If the schedule is operational, then you should provide the rates now. But if you actually see, the schedule is linked to the section on dividend, and that section of dividend has not yet been notified. So my belief is that still we can follow the old rate of this thing, not necessarily the new rate, and that's a view. As I said, many of this, it's important that there is emphatic clarity which comes up, but this can make a dramatic impact, particularly if you see that great thing about continuous process plant. I know one used to argue that a continuous process plant is designed and required to run 24 hours a day, but it has a lower depreciation than a plant which runs 3 shifts. So, which was bizarre, which was 4.75% earlier on a straight line basis, which has now been corrected, and now you will find that it is a much higher rate of depreciation when you calculate it based on the useful life. So there are dramatic changes based on certain things like, say, furniture and fittings. You'll find the useful life is only 10 years. So there will be an impact on corporates. All it says is, this section says, take the new residual value, take the net book value today, depreciate over on the remaining useful life. If this is the useful life of 15 years, you have completed 12 years, the net book value minus the residual value, you depreciate over the balance 3 years. And if the useful life is over, then the whole amount you adjust against opening reserves. That is the requirement in the section. So it will mean some churn insofar as the financial statements are concerned, and that is something which we have to live with. So it also deals with the whole issue of depreciation on the revalued amount. Now, financial statements and director's report. The good thing is earlier, when we say profit and loss account for the year ended, it always gave the impression that the profit was the period was determined based on the profit. It was not profit for the period, but period for the profit, because if you didn't have adequate profits, you extended the accounting year. Some truncated companies were doing that. Now you can no longer do that. You have to have a uniform accounting year. If you need to have a different accounting year, then you need NCLT approval. Now the point is, you can put a lot of things into NCLT. What is the mechanism, or how soon will we get those decisions? You're talking of National Company Law Tribunal. You need to represent to that. It could, as I said, it's used for many other purposes, including one of that is this. For the first time, financial statements are defined. Okay, I won't get into that issues of definition. That's not the issue. The issue is of consolidation. Consolidation, I explained to you the issue of control, the issue of subsidiary. It also goes on to say a subsidiary for this purpose shall include an associate or joint venture. And if you go to the definition of associate, it says if you hold more than 20% or more, it's an associate. In accounting, it's a rebuttable presumption. And second thing is that what is not clear now. Currently, if you didn't have a subsidiary, but you had an associate, you're not required to prepare consolidated financial statements. You're required to prepare consolidated financial statements only if you had a subsidiary. Second, under the accounting standards, if you had a subsidiary which you had acquired with a view to dispose, you didn't need to consolidate. Third, in accounting standards, which is the International Accounting Standards and Ind AS, if you are an intermediary holding company and your ultimate parent publishes consolidated financial statements, you need not publish consolidated financial statements. Now, this does not deal with that. Through the rules, they are only talking about a situation where if you have a parent outside India, then the Indian holding company shall prepare consolidated financial statements. But what about intermediary holding companies in India which are unlisted? Why should they not be exempt? There is too much of a cost. We continue to have multiple layers, which is a reality. Would you prepare consolidated financial statements for all of it? And that difficulty needs to be removed. That can be done, and I think that's very important insofar as accounting is concerned. Then there is an issue of audited accounts to be given. There are two issues I've run through a little faster here. Board of Directors report. It talks of board of directors to discuss the performance of the holding company, standalone company, no problem there. It also requires the board of directors to discuss the operations and financial position of each subsidiary. Imagine all these companies, Indian companies, which have a global footprint. Take any of the software companies, name it, whether it is any of these top software companies. They will operate in 53 countries or whatever. They may have 70 to 100 subsidiaries. You mean to say a director's report shall discuss each subsidiary, the operations and financial position? Or should it be material subsidiaries? Or should the board of directors report discuss consolidated financial statements in addition to standalone financial statements and consolidated operations? I think there needs to be far more balance there. Currently, the way you see the rules, it would mean every company. It also means that the shareholder has a right to receive the annual report of every subsidiary which he wants on request, which is a nightmare, if you were to give a hard copy to a shareholder at his request. I think we are going green in a way. We should, when you prepare consolidated financial statements, material subsidiaries, information should be available electronically, and I don't think we should get into this hard copy, so there are some issues. Two other things in accounting. One is a requirement for now a new thing of voluntary restatement and mandatory restatement, where a regulator, government, any other person finds that the financial statements are prepared fraudulently, you'll be required to revise the financial statements. And then the question comes up, is the National Company Law Tribunal can ask the auditor for explanations. Now the institute, I think, is representing to the government to say why just the auditor. Even the board of directors should be asked as to why the accounts were prepared fraudulently, right? Why you pick on only this poor auditor? But this law seems to be for auditors, and therefore maybe that is the reason. And that is a variation which comes in. But then you will have issues as to what if the auditor is different from the earlier auditor? What if the auditor is the same? Who will issue the report on the revised, restated financials? So I think there needs to be a little more clarity around that. And as I said, I won't get into the director's report. Now, audit and auditors. Let me spend about 10 minutes here before we. Let me give you the big picture and why I'm concerned, having regard to the fact that we have this new law and having been in the profession for so many years. Look at this whole Companies Act at the multiple levels, the way it deals with, and I'll take you through some of those. First is the level of the professional body. The law creates Section 132 constitutes the National Financial Reporting Authority, NFRA. And under the law, then NFRA, and believe me, there is no body, equivalent body in the world, not even in the United States, not even in UK, not even in Singapore, there are different. This body formulates or in a way sets or recommends, you can use different terminology, forget the act, in reality it sets accounting standards. Second, it is required to ensure compliance with accounting standards. That means that body will ensure that every company in its financial reporting complies with accounting standards. And I'll tell you how it may do it. Thirdly, it sets auditing standards for the first time. Earlier, accounting standards were only set by the NACAs. Now we have auditing standards. And if you look at the law, 2009 bill had only one additional alphabet A. From accounting standards, they added on auditing standards. Then it went on to say, it shall monitor and enforce compliance with auditing standards. And how does it do? In the fifth way, it shall inspect audit firms. Further, it has the power to investigate, and when it starts an investigation, institute cannot investigate that matter. Any matter taken up by NFRA cannot be taken up by the institute. And lastly, it has the power to punish. So set standards, monitor and enforce compliance, set auditing standards, monitor and enforce compliance, inspect audit firms, investigate, punish. All rolled into one body. In United States, for instance, the Public Company Accounting Oversight Board only oversees the auditing profession. It doesn't set accounting standards. It only sets auditing standards, inspect audit firms. And again, certain class of companies whose accounts are audited. We have no visibility currently as to what shape NFRA will take. The law says NFRA shall be nobody who is a practicing accountant can be a full-time member of NFRA. Now there is a lot of discussion around which is happening as to what role the institute can have in NFRA. Can the president be in NFRA in some form or not? Can he be part-time? Full-time is out of question because it says anybody holding a certificate of practice who's a practicing cannot be in NFRA. But if you look at the law, in what I'm going to talk to you in the next 10 to 15 minutes, don't sit back and look at it saying it doesn't affect me. Address the issue, because when you look at the issue, it doesn't affect you today. Address the principle. If you don't look at the principle and say it doesn't affect me, it will affect you tomorrow. And the question then will be, you've created this body. The immediate statement may be, no, this body will only oversee large firms. Maybe a beginning. But when you create a body, and the vision seems to be, I don't know whether that is the final vision, that it will not outsource. Today, if you're looking at audit quality. How is audit quality enforced? How is financial reporting enforced? Let me start with the first one. Financial reporting is enforced through the ROC mechanisms. They come for inspection, look at it. They've also gone overboard in many cases, including saying, when you say cash and checks in hand, they're saying you're not shown separately. No law requires us to show separately, but that's a different aspect. The inspection of audit firm, then you have the Financial Reporting Review Board of ICAI, which picks up financial reports, looks at them and writes to the auditors and to the companies. Then you have now the Quality Review Board. For now come to inspection of auditors. You have the peer review mechanism. You need a peer review certificate to do listed companies, which is by our own members. You have the Quality Review Board, which also now inspects audit firms on two parts of it. It inspects the audit firm's systems and processes. It inspects the audit firm's quality of a specific audit. And QRB inspections have now been activated. But even now, QRB is also outsourced. It is like a peer review, but perhaps far more intense because the checklists which are given and all are very, very detailed. And there is a board which comprises of independent persons too. It's no longer institute which looks at it, and it's not insulated from the disciplinary mechanism like the peer review board was, and therefore there is. But this is a new dimension now. So there is no clarity whether those existing mechanisms will be dismantled or will coexist, but you will have the NFRA comprising of people who are independent of the profession. That's the vision, who will inspect the profession and ensure quality. So you will have inspectors who will come and look at your audit files, look at your firm, who are not necessarily chartered accountants, who will not be, who may be full-time people of the government. That's how it is done outside India, but if that is implemented, that is the beginning. And that is the beginning of the oversight of the profession, independent of the profession. So at the first level, the law affects the professional body. Then the question is, what does it leave for the professional body? That one needs to look at. Then the second is, I'll talk about the general provisions and then come to these specifics, is the profile of the profession. First, you're attacking the professional body or changing the professional body. I'm not using the word attacking. Second is the profile of the profession changes. How does it change? At least in two ways it can change. First is, you say, rotation of audits. Good, bad, right, wrong is not the issue. That is not what I'm going to debate at all. That's a different aspect altogether. But the first point is, there will be a churn. But what is the principle there? And that's why I'm talking of the principle. The principle is the principle of familiarity. And if you accept that the principle of familiarity needs to be addressed, and that needs to be addressed through this mandatory mechanism, then the question arises, why not tax audits? Tomorrow it will be extended to tax audits. You have a client who is your tax client, you have served that client for so many years. You are attesting, and that's a tax audit, and it will move to every other attest function. And that is the issue of familiarity as a principle. Now you can argue that, look, familiarity can be dealt with in different ways, maybe rotation of partners, but more importantly, if you want quality, you have oversight. And that may be a view. And if you look at many countries in the world have actually introduced rotation, some countries, not many, introduced rotation and reversed rotation. Korea did it, certain other countries did it. Rotation is there in Italy, and rotation is there in Brazil. So the question, the merits of rotation apart, all I'm trying to say is it churns the portfolio of the profession. That means your existing way of you operating is changed. Second part of it is limit on number of audits. The way the law is written, you shall have a limit of 20 companies, not 20 public companies, not 20 listed companies, but 20 companies per partner. Now when you do that, what happens? You're equating a company with a 1 lakh crore turnover with a company of 1 lakh turnover. Both are one in number. Size is irrelevant. And if you apply 20, and some people have come up with that statistics and given it to the government, saying if you apply this 20 limit to all companies and per partner, there are not enough practicing firms in the profession to be able to handle. Right or wrong, I don't know. All I know is it will change the profile of the profession. That's the second part. The third part, it deals, you have dealt with the professional body, you have dealt with the profile of the profession. The third part is the tenure, rotation is part of the tenure, I won't get into that. The third part is what the auditor, let's take the disqualifications of the auditor. And when you come to disqualifications of the auditor, if you see the way disqualifications are, when you read the section, seemingly innocent, that we had earlier law also, you shall not be indebted to a company exceeding 1,000 rupees, you shall not hold securities, very fine, no problem there. But they've gone overboard in saying you shall not hold securities exceeding 1 lakh, you shall not be indebted or exceeding that amount, you shall not give any guarantee, and all that as may be prescribed. But the key issue there is the person or his relative. And the biggest problem is in the definition of relative, because that's one of the other topics I'll come to as soon as I finish this, is this whole serious issue of related party transactions. The definition of relative is very wide. There are 15 different relationships which are mentioned. Fundamental to relationship is that principle has been completely ignored, is the principle of dependence. You can write father, mother, brother, sister, grandfather, grandson, son-in-law, whatever it may be. They should be dependent on me. I have no idea what my brother does. In my own case, my brother is in the United States. What he does, I have no idea. Yeah, he's my brother. I have more than one. So if you look at that and try to apply that, and the day let's assume he acquired a share. He doesn't even know which companies I audit. I may be a partner in a firm. I sometimes don't know which companies we audit. It does happen. It does. I mean, in reality, it can happen. Of course, I know which companies I audit. Okay, so please don't mistake me on that. Otherwise, I will have an issue. But of course, we all have mechanisms in place. That's all fine. But surely my brother doesn't know. Let's assume he picks up certain shares in that company. Based on this trigger, or he gives a guarantee for a loan for a housing finance company or whatever, I am disqualified as an auditor overnight. He's not dependent on me. For all you know, we may be fighting day to day. For all you know. It also means that if before I get my son married, I must ask my prospective daughter-in-law what her portfolio is. Because the day she becomes my daughter-in-law, we may lose. But I'm only telling, it may seem humorous, but the reality is that it triggers an issue. And the principle is the missing principle here is the principle of dependence. That is one very significant thing. It says relative, and there's the second principle in relative, which I think is very important, which there was deficiency even in the old act to some extent. It is, I am related to you. You should be related to me, right? But it's not necessarily so. So if, let us say, a son's wife is included, a husband's father is not included. Right? As an example, if I may give you, one can look at it specifically and argue, but that's more minor than the larger issue. The second issue in this disqualification is the term business relationship. You shall not have a business relationship. And the way it is written, business relationship, there is the missing principle there is the principle of normal business transactions. One can read deeper and deeper and interpret to say an audit firm only if it's deriving income through a business relationship, there is a disqualification, but nowhere in the law is that situation there. Because independence can be impaired not because I get income. I can do it different way. Let's say I'm an auditor of a hotel. If that hotel charges me 1 rupee for a room of 10,000 rupees, isn't my independence impaired? Should I be disqualified? And the way this term uses is generally business relationship. Now, is that issue of normal business transactions, which is regular for that company, if I have to fly Jet Airways, I have to fly Jet Airways. That's the only flight available. Merely because if I'm the auditor of Jet Airways, I cannot fly, I don't think that should be the intention, right? But if you read the law, I think there is significant ambiguity and which needs to address, and it affects all of you. You may buy a product from your client, you may sell you won't sell a product with your client. So the intention logically should be where you market along with your client or do something which earns. There is enough material in the global space to be able to look at it, but this ambiguity remains. So therefore, this is the third component which I said of disqualifications. The fourth component is what an auditor does. And in there, they've introduced this concept that the auditor shall comment on internal financial reporting. And if you look at the provisions, internal requirement to comment on internal financial reporting applies to directors of listed companies, but to auditors of all companies. The whole intent was to take on from the equivalent of the Sarbanes-Oxley Act in United States and put that in. And hope if it is of that rigor, perhaps it's expensive, it is good though, but it cannot be applied to everybody. You cannot really do it. But the way the law is written, it applies to all companies. All we are saying is when the director is not required to confirm that it complies with there is an internal financial control mechanism, why are you expecting the auditor to? And if you look at the rules, they've introduced in terms of what he shall report 3 more items. That you shall report whether provision is made for all foreseeable losses, including for derivatives contracts. Now, why would you do that? That's part of accounting standards. Why should I say all that? And it's already we are struggling with this whole issue of derivatives and its accounting. But if you look at what's been prescribed in the rules, they're still draft rules. I don't think you should use the auditor as a mechanism. You can require companies to disclose what they do. Auditor confirms through his report that everything is true and fair and the disclosures comply with the law. You can't use an auditor as a vehicle for reporting things which the company itself is not bound to do. So the fourth component is you've changed the way an auditor is to report, and in that there is one more dimension. And that dimension is under section 143(12), an auditor has to report on frauds, committed or about to be committed. Okay. And mind you, I have said this to the other fellow professionals, audit would include secretarial audit and cost audit. It does not say that when a cost auditor is doing a cost audit, it should be a fraud in relation to cost accounts or cost records. No, because the section is sweeping. And what is fraud? You go to section 447. It's so sweeping. Please read the definitions. You'll find it so interesting. It's got nothing to do with monetary. Whether there is loss or no loss, whether monetary, non-monetary, about to be perpetrated, or by the employees, on the company, supplier, on anybody. So it almost brings me to the issue, if I as an employee sell you a product which I know to be defective, isn't it fraud? I know my company is selling defective products. Now is it my job to blow the whistle and report to the central government? And it says whether loss is incurred or not incurred. And about to be committed, I don't know how one can do it. So I think the professional body is taking this up seriously and saying, please spare the auditor. So the fourth thing is you put such a burden on the auditor that tomorrow anything which happens, you didn't blow the whistle. You're required to blow the whistle even before it happened. You could have seen it through this process. Please read the definition, it's far too serious. The fifth, you have dealt with the professional body, the profile of the profession, qualifications of disqualified auditor, poor man, what he has to report. Then the fifth one is punishment. He can be punished, his firm can be debarred, he can be put in jail, his fees can be clawed back, and lastly, you will inspect him. Through NFRA, you will do everything. Now, if this isn't completely shaking the profession, what is left? Is your life the same? So not only your body is, so it's almost like for a problem of one member of the family, you've dealt with the family, you've dealt with others in the family, you've dealt with the earnings of the family, you've dealt with what the family can do, and the family is under a scanner. Special treatment is given to the family that you will cool your heels in jail, whole host of things which are not reserved for other sectors. So collectively, when you see the provisions, it is disturbing. The question is, why do you need to do this? And This is the issue of rotation. There is still, the rules say rotation is retrospective. How will it be retrospective? You will count, what should be, there are lots of ambiguities here, because it says you shall not have a common partner at the point in time. Equally, the rules say, even the section says, you shall appoint for 5 years at a time. It also says that you shall come every year to the shareholders for confirmation. The law does not deal with what happens if the shareholders don't confirm, because there are special provisions for removal of the auditor, which requires permissions. So law is silent on that. Why, if you're appointing for 5 years, why confirmation? All this because investors came up and said, we always had the right to appoint shareholders every year. You've taken away the right. So government said, okay, we'll give you that right. They'll come to you for confirmation. So one more clause got added without realizing it's inconsistent with the main one, which says you shall appoint for 5 years. And after 5 years, if you're a firm, you shall be eligible for another 5 years. Otherwise, it will almost equivalent to a removal, and then the provisions come in. I didn't get into, when I talked of accounting, I didn't, for lack of time, get into this issue of accounting records in electronic form. You'll find that also is a very interesting provisions, because it says you shall maintain and preserve it for that period in the same manner as it was received. How will you preserve? Now, I've been asking this question, I've yet to get answers. Let's say, for those who, maybe a simpler example would be, say, Tally. Let's say you had a Tally version which is 4 years old. You've gone multiple versions, you have changed. Today you have a new Tally version. Now it says that the records of those years should be capable of being read, should be capable of being printed, everything. Now if then older version I have kept in those days, and assuming I had kept in floppy disks, no longer do we have copy disks, even CDs are disappearing, right? Let's say I have preserved. And how will it be readable today? Should I reconvert all of this into my new software? If I change from a Tally to an ERP system, what do I need to do? Still preserve that original Tally software plus the records in electronic form. Also it says you shall not do anything, you should also preserve in the original form in which it was received. That means from a branch or any other place they send me in Excel spreadsheet in a certain format. I convert from Excel to Hyperion for consolidation or do something. Do I preserve that Excel plus this Hyperion plus that original format? If it is Word of a different format, I convert to Excel. I don't know. But if you read the whole issue of electronic, it's very interesting. I know it's a challenge in technology, because even when you look at foreign company, you have this whole issue. Foreign company will be deemed to be doing business in India even if it is doing through electronic means. So I don't know whether a pure email which foreign companies send will be deemed as if they are a foreign company registered in India. So there are challenges there. I spoke about rotation. I won't talk about auditor's appointment. There's one more thing which it restricts is the services. In addition to all which I mentioned, it further restricts in what you can do to your client. You had a churn of portfolio, you went through the difficult disqualification route, finally you got an audit client. It says you shall not do ABCD. You should not only do it to its holding, to its subsidiary, to its associate, directly, indirectly, sharing network, brand, whole host of things. Extremely impracticable in the way. Principle is right here. The principle is you should not have a self-review thread. You should not be in a position to review your own work. You should not render management services. They've used the word management services. It should not be management consultancy services. You can't be managing the business. You can't do an internal audit and do a statutory audit. Those principles are right. But in the wording of the law, there is an issue here in so far as proscribed services are concerned. Okay? Internal auditor. Very interesting if you see section 138. The way the section is worded, internal auditor shall be a cost accountant or a chartered accountant or any other professional as may be prescribed. And then when you look at the rules, it tells you which type of companies need to have internal audit. And it says you can appoint a firm of internal auditors. But if you see the larger firms of internal auditors, larger entities today are limited companies also doing internal audit. Conceptually, if you see, you will have to do that because a lot of it is technology driven. You can't have technology professionals unless you have a corporate entity. There's nothing wrong in having a corporate entity. So here is where the law is inconsistent with not only the rules, but with the current practice. One has to wait and see as to how this will. Otherwise, it's a welcome move to have internal auditor for a certain set of companies. Dividend, nothing new in dividend, except dividend out of profits of past years you want to do. You need to, it's again back to a percentage of free reserves, and you have all the problems of free reserves, which I said insofar as definition is concerned. Let me spend time on related party transactions. With the last, and I will take questions. Just spend 5 minutes. Now, related party transactions, if you see, I won't get into, there is now a key management personnel for certain class of companies, which is all good. However, related party transactions, the real issue is you've done away with this whole taking central government approval. So what does it first there is this definition of relative. Fundamental to relative, as I said, when you're talking of individual, is dependence. When you're talking of non-individual, I think you need to have either of the two or both, which is control, and the second is influence. If you look at broadly conceptually, and I have been saying this including to the government, I said, and including developments which are happening in OECD on related party, is I would say when you're looking at related party transactions, first concern should be abusive related party transactions. That should be the larger concern. Every related party transaction is not bad in law. If I am an automobile company, I will assemble cars. I will have subsidiaries for engine, I will have a subsidiary for transmission, I will have a subsidiary for many other components. Because the technology provider for engine will be different from the technology provider for transmission. These will be separate joint ventures. They're all joint ventures or subsidiaries as the case may be. Why would I need to have everything under one umbrella? Now, that company will supply engines, another will supply transmission, I assemble the finished car. That's 100% subsidiary. Is there anything wrong with that related party transaction? No, it's not an abusive related party transaction. Therefore, you need to identify what are abusive related party transactions. Second, for those abusive related party transactions, you put them through a special tight process of seeking approvals. Third is you take all related party transactions, which are not necessarily abusive but are of a certain size, through another process which is not so rigorous as the one which is abusive. And lastly, you have a mechanism of reporting all related party transactions. This has to be transposed in the context of relationship, and in the relationship, as I said, is either related as individuals or by way of control or influence. There are other concepts which are alien, which are not necessarily applicable in India. Is the relationship at a point in time, or is the relationship over a period of time? Typically what happens if you want to get around a related party transaction, I am related to you or to a lady, let's say, I divorce her, enter into the transaction, maybe remarry her, right? So at that point in time, I'm not related. Similarly, in companies, that relationship is severed, the director steps off the board, no longer a related party, transaction is entered into and steps out. In some countries, you have relationships saying if in the last 1 year you have been associated or within few months before or after, it captures that. I don't want that to be so complex in our current situation, but what is the issue here? The issue, the positive side, central government approval has been taken away. In the negative side, it says, yes, related party definition is wide, you shall take board approval. However, what is exempt is related party transactions which are on arm's length basis. Who will, if it's otherwise, many transactions you will require beyond a certain limit, and that limit under the rules, as you would see, is 5% of net worth or profits, I think, and there is a percentage of net worth. You require prior approval of the shareholders. Now, if I am a subsidiary company supplying components to me, or a services company which I operate all over the world, how can I go and take prior approval? Many of the multinationals have said we can't operate at all. We have supply chain arrangements, global supply chain arrangements. And arm's length, who would determine arm's length? You are well aware of all the transfer pricing issues which is there. What is arm's length? On the one side, you are battling transfer pricing to say it's not arm's length. Somebody held a view, it's not arm's length. And on the other hand, you haven't taken prior approval of the shareholders. So there is a huge issue in related party transactions, and I would urge all companies having subsidiaries and related party transactions to very closely look at this provision, because it doesn't say who determines arm's length. Somebody can come and say, you have lost arm's length in this, so you should have obtained. And the penalty is not just fine, is imprisonment also if you violate the provisions. How can you? Why would you do this? So there is this serious issue, and there are list of transactions or to what it applies. They've extended the transaction to leasing of property of any kind, which was not there in the earlier law. They said property is not goods. So that was, but there is yet another important principle here, or rather two issues. One is the fact that you need to have the director or the member who is interested shall not vote. So if you're a wholly owned subsidiary, I wonder how it works. It also says that if the holding company, if it's a transaction between a subsidiary and a parent company, the parent company shareholders approve, it's all right. It seems a little bizarre, but the real issue is introduction of a new concept. And that new concept is vote by the majority of the minority. Remember this is a new concept, vote by the majority of the minority. We've had, maybe it's also because of certain recent corporate transactions. We had one company in southern India, we had one company in western India, where there was significant related party transactions, where institutional investors opposed it, where the non-promoter shareholders opposed it. 83% of the non-promoter shareholders opposed the resolution. Yet the resolution was passed by 65% majority, because the promoter had that much that went through. But that may be one case. You need to have mechanisms to look at abusive transactions, step in as a government. But if you were to introduce this concept of majority of the minority, or non-interested, when I mean minority, I'm saying non-interested, you are giving power into the hands of that small section of shareholders for approving a related party transaction. It can be nightmarish. One has to wait and see as to how this works. This is in substance an issue which is there. I talked about prior, it says 5% of the annual turnover or 20% of the net worth. Okay, if individually or taken together, the transactions, then you need all this process, prior approval of the shareholders. Of course, the generic exemption is if it's at arm's length, but that's a very, very difficult situation here. And also look at this, remuneration to a related party in a subsidiary exceeding 1 lakh per month. Today, 1 lakh per month, 12 lakhs per annum, a lot of people get that threshold. I don't think that's a very, very big amount in terms of remuneration. So in the interests of leaving more time, I think there are other provisions, loan to guarantee, there is investments of CSR. I know a lot has been spoken about CSR. There is still a lot left. What clarity is pending in CSR is corporate sector saying we need tax exemption. Corporate sector is everybody talks of 2% of profits, but it's profits before tax. So effectively it's 3% of profits. Then we have the bizarre situation is, it says you shall do it in the area in which the company operates. It lists down, I think it's that Schedule 7, which I hope I'm right, Mr. Sada. Okay, which lists the activities and it has the residual, which also says you can write a check to the Chief Minister's Relief Fund or the Prime Minister's Relief Fund. The Chief Minister of Chhattisgarh has gone public to say you shall pay 1,000 crores to the Chhattisgarh government. And his officers are implementing that rigorously now. So effectively the government is stepping in and saying, yeah, now we have CSR. We have calculated the corporate sector profits operating in our state. 2% of that or 3% of profit, net profit works out in Chhattisgarh, he calculated works out to 1,000 crores. He says you shall pay 1,000 crores. Your cement plant, and I know of a cement company which spoke to me, the chairman spoke to me, was crying. He says, this is what they have come. The officers have started coming, saying, start paying up. And not contribute to Chief Minister's Relief Fund. That is very easy. They created a Chief Minister's Development Fund, I am told, in that state. That's a separate fund. I don't know what that means or how it will be used. But there's lack of clarity today in terms of the way the rules are framed. If you see, you can do it through an NGO, provided you're able to track the expenditure, and that NGO has 3 years experience in that area. It also says you can do it through your own trust, etc. But the way the 3 years rule is written, it may also apply to your own trust. I think some more clarity is required. There's a lot of opposition to CSR, so I don't want to speak too much about it, because this industry will take very good care to see that this CSR is fairly tightened in the way it is. Because it applies to every company, as you would see, which has a net profit of 5 crores or more. It's got nothing to do with a listed company. There are issues when you're talking of average net profits. If 1 year is a loss, do you subtract that loss? Do you ignore that and treat it as zero? I know, just like we have enough debate and taxation, we will have in all of this. The list goes on and on. I think in the interest of time, I'd be more than happy to discuss, take questions, and whichever way it is. The rest is all provisions relating to directors and board meetings. I'm sorry there are too many slides, but you can please distribute these slides. Okay? I have spoken about merger. That's it. Registered valuer is a new concept. For the first time, you'll have registered valuers. We'll have to wait and see how this shapes up. A lot of it is NFRA. I spoke. I don't want to say anything. SFIO, provision relating to audit. Yes, now we have the SFIO. Class action suits are there against auditors. Clawback of fees I spoke about. That's it. Thank you very much. I'm really sorry I've left very little time, so I'll leave it to the chair.
Thanks. My apology, we could not arrange a bigger venue for several challenges were there. So my apology for inconvenience caused. Please be patient for some more time. We have some time for question answers as well. Thank you, Ramesh, for excellent analysis of key provisions and sharing your insight and views. Indeed, this company law 2013 seems to be an instance of hard cases making a bad law, as was commented long ago by British Judge Robert Wolfe in the case of Winterbottom versus Wright in 1842. It is very natural that difficulties and challenges highlighted by you trigger emotions of apprehension and anxiety amongst all of us. As you rightly pointed out, the key will be in ensuring fair and equitable administration of this law. A duty is also cast on all of us to voice our concerns loudly and appropriately rather than just play the role of victim. I think we have some time for question answers, and I would request you to please raise your hands.
Yeah.
Mainly because of time constraint, we cannot speak on the intercorporate loans part.
Mainly because of the time constraint, we cannot take up on intercorporate loans part. But as the current parallels, it appears that there cannot be intercorporate loans with the related companies. It can be permissible in this current context. Is it going to be the scenario? And if so being, if the law is already being implemented, that's going to be a difficult transaction to handle across.
True, there will be difficulty, including the fact that if you have a foreign subsidiary, which rate will you give the loan? You see, the borrowing rate in that country will be completely different from your rate here. And that's an issue which needs to be addressed. But conceptually, if you see, in terms of lending, and I always said this, today, if you look at the corporate landscape, you will find that there is a lot of intercorporate lending which is happening to entities which are outside the control of the principal shareholder entity. So I have seen intercorporate, the term used is intercorporate, but the lending happens to sole proprietorships, partnership firms, and through that the trade is completely lost. So the real intent is that if you have intercorporate money, you should either do it through the banking system, which is mature enough to lend, or you should be able to lend at a rate equal to what a banking system has. So hopefully there will be more transparency. For the long term, absolutely more. Clearly for related party, it is governed by the related party transaction. That it becomes extremely difficult to enforce doing such transactions. Right.
Some more questions.
Yes.
What are the penalties imposed on non-compliance of the CSR requirements?
Well, thankfully, as the Minister of Finance again said, and the way this was the delay, it says you comply or disclose. There is no penalty today, and just like you have this term creeping acquisition, you have to remember there is creeping legislation. Always there is a beginning with a view to reach an end state. Right? So today there is nothing, but if it is mandated indirectly, it is mandated, specified, you disclose. I don't think it's far, the day is far away that it compulsory in terms of spending, otherwise you have to disclose. But today nothing.
Within that section which gives an all overriding penal provision for any of the provisions of the section of the Companies Act if it is not complied, would apply for CSR?
No, specifically it says, because the section specifically deals with a situation where if you do not comply, you shall disclose. It should link to that overriding section, otherwise, I mean, don't give those ideas because then that will be used for every other purpose. Yes, please, this side.
CSR activities to the own trust or foundation will be allowed subject to trust having experience of 3 years track record.
As I explained, if you see the rules, CSR rules, you have a paragraph 3, a paragraph 4, and a paragraph 5. Paragraph 3 where you do it through your own trust. Paragraph 4 is where you do it through an NGO. Paragraph 5 says such spends, and it talks of shall be through organizations, shall be where there is 3 years of experience. So it may, that such spend may relate to para 4 if it is so fine. It means the NGO should have 3 years of experience. But the way it is worded would lead to a situation where even your own trust should have had 3 years of experience in that. So that's why I said that ambiguity needs to be removed.
What about deductibility in income tax?
There's a big representation. There is, again, if I were to reproduce what is stated in public by the minister and the ministry officials, they have said, and if it will give you comfort, they have said we will be your ambassadors to the finance ministry, representing to them that deduction should be allowed. And that means Mr. Sachin Pilot will be your ambassador to Mr. Chidambaram. If that works, good day. Yes. I am not able to hear. He'll give you the mic.
Can an existing company with 2 directors or 3 members or like that now become a single director or single member company now?
Well, first of all, you have to look at the threshold in terms of size. I believe
Suppose
if
the
you,
threshold is below the threshold, then it allows?
in my view, no. Because this one-person company should be formed as a one-person company. You can't have an existing private company
Converted
becoming
that
a one-person company. Maybe if the other director expires or no longer there, we can perhaps see. But
No, but this arises when a person means one of the directors is in foreign country.
yeah, that can happen. You're right. You're right. There has to be minimum 182 days. There should be at least one director with at least 182 days in India, right? So, if both the directors are not there, you need to find at least one director. But that doesn't make it a one-person company.
That is not possible. So one more doubt.
Yes, please.
This video conferencing of board meeting, have they allowed it?
Yes, they have. But the bizarre thing again is that you shall maintain a record. Now, the point I'm trying to make is you didn't have video, right? Did you record what everybody said? No. Now, whether I participate through video or physical, when I participate through physical, the decisions of the board are recorded. He didn't say Mr. Ramesh stood up, Mr. Ramesh slept in between, he didn't say all that, right? But a video recording shall record all that. Why? But that's the way the law is.
about that, there is one valuation committee to be formed.
Yeah.
And
There are,
what are all the specific regulations? Who can be part of it and any qualification? Just throw
you
some
mean
light on
registered
it.
value?
Huh.
The concept of registered values? Yeah, there will be a process for accrediting valuers and registering valuers. That is yet to take shape. But the law today prescribes that in certain situations, the valuation shall be by registered valuer. Like for instance, if you want to issue capital on a preferential basis, the pricing shall be by a registered valuer. The whole process of accreditation of registered valuers will happen under the law. That is a process which is getting found out in the rules.
In case of valuation,
Last question.
different situation will arise at different time. Under income tax act, they said if you want to issue shares at a premium, the chartered accountant can be a valuer if he is a fellow member. Now under companies act, if you say same company is going to issue the shares, then the registered valuer will be different than for income tax purposes.
Well, yes, if your valuer who's under the income tax is not a registered valuer under the Companies Act, yes. That's the reality.
But in earlier period, there used to be registered
No,
valuer
no,
in the
no, no,
company
no,
law
no,
board
no.
itself. Company law board was registering the chartered accountant as valuer.
Even now they'll go through that process, but you are envisaging a process where the person is not registered. If a person, or rather the person who's done the evaluation income tax is not registered under the Companies Act, that could be a theoretical possibility, that could be that. But you will then necessarily need to follow that process of appointing registered. Yes, there's a lady there.
Just a minute, please.
As a group company together form a trust for CSR.
It says, these CSR rules, they are not very well written. It says more than one organization can work collectively towards undertaking projects. And my reading therefore is if you can work collectively towards executing projects, you can do it through the same medium, whether it is your own trust, collectively formed as a group, or through an NGO which is limited. But the principle is, yes, but the principle is you must be able to monitor that and it's your spend. It's not about writing checks. Yes, you will be able to throw more light.
Sir, what is the now role of the Institute of Chartered Accountants of India after this?
Will you be able to provide immunity to me in any way or indemnity? See, the reality is, NFR, it's a serious question, I agree. The reality is, as I said, always there is a start point and one really doesn't know the end point. The current vision in all these discussions which are happening with the government is more likely that the NFRA will restrict itself to larger audit firms and maybe supervision of financial reporting of larger entities. That is the intent. Because they will not have the infrastructure, they will not have hundreds of people to do the necessary inspection. A. Therefore, by implication, the Institute of Chartered Accountants will continue with this. Initial thinking of the government was that the QRB mechanism and the FRRB mechanism will be discontinued. The current thinking does not seem so. Currently, they said, let the existing mechanisms of the Institute continue. We will focus on something, and what we focus on and we start, the Institute is excluded from. That is in the law itself. There is a third issue which will never go away, is that the Institute exists for non-corporate bodies also. So whether it is setting accounting standards for non-corporate bodies, managing for that, it is there. Now you may say how large they are and how much it is, but that is a role which the Institute has to play and will continue to play. I can't see the ministry stepping into this. The ministry also is of the view, and the way the law is framed, that the ROC mechanism will not be dismantled. So you will also have, they said that is there in the Act and in the law, we cannot do all that, and FRA we will see how it is. The only hope is that NFRA will take time to get formed. You need to select that group. The selection process, and as any body, will be as good as the leader
and that would depend on how the leader is selected. One vision is that their vision, and I keep hearing this in various is that it should be in the lines of the Competition Commission. If you see the Competition Commission is very vibrant, Competition Commission chairperson is virtually independent, not a political appointee in a manner. If they follow the same process, then NFRA will have to. Today, everybody is scared of the Competition Commission. You will reach a situation like it is in the United States where two CFOs in the same industry will not meet in a restaurant, even on a social basis. Because the Competition Commission or the antitrust supervision will be done. So if they create such a body in NFRA, then you can expect an oversight of the profession which is far more rigorous than and far more independent, whether we like it or not. Because we will have no member full time from the profession on us. So the future of the profession, as I said, they have struck at the first strike has been at the professional body. Then at all levels. Never before have I seen one law which impacts everything. That's why I said there's a law for auditors or accountants.
I think as Arnab Goswami would say, we have completely run out of time. Just be patient for a few more moments. We need to honor our speaker of the day. And I request Manish to do the...
Well, thank you for referring to Arnab Goswami, because true to him, I have also not given others an opportunity.
Thank you, Nitin Bhai. It's always a matter of great pleasure and pride to propose a vote of thanks to a person like...
You'll have to wait till it works. You need this?
Okay, I'll come there. Thank you. It's always a matter of great pleasure and pride to propose a vote of thanks to a person like Mr. P. R. Ramesh. As most of you all are aware, whenever we had a new concept or new challenge on our profession, be it IFRS or in 2011 the Schedule 6 which got revised, and now the company's deal has always been there. Thanks for being the part of BCA family and our friend. Taking clue from a friend of mine who obviously is standing, all the people sitting here, please propose a vote of thanks to him for a very and the people who are standing for their unrealized dream. Thank you.